like to thank everyone for joining us this evening. Obviously, tonight's topics on dissecting the put spread. We're going to go over that in detail in just a few minutes. But before we do that, I want to go over the basics. As we do in all our events, we try to go over the basics in the beginning so people who are new can have a little foundation at least to be able to understand what we are discussing. So let's jump into the basics here. All right, so we have options, the basics of options. And what are options? Options are contracts called puts and calls. A standard put or call represents 100 shares if trading stock options, right? If you're trading something else like futures, it doesn't necessarily mean 100 shares, but we're going over the basics tonight. And we're going to be talking about mostly regarding stock shares. Options can be bought and sold at different standardized strikes on an options chain. We're going to go over the option chain in just a bit. All options have an expiration date. So options can expire today, tomorrow, or they can expire years from now, but they do have an expiration date. It all just depends on when that is occurring. Okay, so when you are buying a call, just as this graph indicates, you are what is called bullish. You want it to go up, as this graph indicates. When you're buying a call, you want it to go up, you are bullish. Okay, so whatever you're trading, you want it to go up. It's just like buying 100 shares of stock. You want that to go up, you are bullish. If you are buying a put, then you are what is considered bearish. You want that underlying, whatever you're trading to go down when you buy it, okay? And when you buy something, monies are coming out of your wallet, coming out of your purse, it's coming out of your account, okay? Now, when you see something that's sell on the platforms that we're going to be discussing tonight, then selling a call is being bearish. You want it to go down. So it's the opposite of buying a call. And this is what is difficult about understanding the basis of options, because you have to understand what is a put, what is a call, and then what does it mean when you're buying a call? What does it mean when you're selling a call? What does it mean when you're buying a put or selling a put? So in this case, when you're selling a call, you are actually bearish. You want that underlining that you are trading, whatever you're trading, to go down. And when you are selling a put, you actually want that to go up. So you are bullish. You want it to go up. You are bullish. So that is a quick introduction of what is a put and a call and how buying and selling one operates. Let's jump over to an option chain here. And let's discuss the option chain, because it's important to understand how an option chain works. This is how you buy and sell calls and puts. So when you're looking at an option chain, whatever platform you're using, especially if it's a platform that specializes in option trading like Tastyworks here or Thinkorswim that I'm about to show you, calls are always to the left and puts are to the right. And the horizontal line right here, this orange horizontal line, is the at the money line. And then down the middle, this vertical area, this is where the strikes are at. And if we go over to the Thinkorswim platform, you'll see it's pretty much set up the same kind of way. You have calls to the left, you have puts to the right, and this is how the horizontal at the money line looks on the Thinkorswim platform. And then this is the vertical area of the strikes. All right, so let's jump back over to the Tastyworks platform and let's continue this. All right, so when you are looking at an option chain on the call side, above the at the money line is considered in the money, the ITM. And below that line is considered out of the money, the OTM. And on the put side, above that line is out of the money, and above it is in the money. So it's the opposite of the call side. It's important to understand what is at the money, in the money, and out of the money. We're going to discuss that a little bit in a second. Then right here, once again, is the strikes. And these strikes are standardized. And standardized just means that whenever you are trading this, wherever you are, if you're in China, India, New York, you're trading the SPX, which we are looking at right here. And the SPX is the S&P 500 index. And if you're trading it with 50 days to expiration, this is the expiration area here. then that just means you can see the same strikes I see, because they're standardized. The exchanges have created the same strikes that everybody can see and buy and sell from those same strikes. All right, so when you are looking at an option chain, it's important to understand a few things about it. And one is the open interest. And on this Tastyworks platform, we have the open interest on each side. And open interest just means what is still open that was bought and sold at a strike price, regardless of the side you're on. So if you were on the call side, then it's how many options were bought and sold at this strike price. Or if you was on the put side, how many was bought at this strike price that are still open, bought or sold that are still open. All right, so also what you want to know on an option chain is the ask and the bid. And once again, this is on both sides of the Tastyworks platform. So the ask is where you can buy at, and the bid is where you can sell that. So if we were selling this buying this $29.50, you click on the ask and it's going to show green. So when you're buying something, just like the chart we just looked at a second ago, when you're buying something, it's going to be green on these platforms. And if we went over to the Thinkorswim platform and we bought the $29.50 as well, you'll see that it's also green here. And so those colors represent buying, red represents selling. All right, so jumping back over here, if we delete this and we click on the sell, then you click on the bid for sale, then it's going to be red. Okay, so that's and when you hear someone say the mid price, it's what they mean is between the bid and the ask. So in this case, the mid price is $51.80, and if you're on a platform like Thinkorswim or Tastyworks, it's going to give you that mid price. So what you can buy it here at this $51.30, but the mid is $51.80. Okay, the mid is $51.80. All right, so next thing I want to discuss on this option chain is Delta. And once again, we have Delta set up on both sides here. And Delta is one of the four major option Greeks. And in my opinion, Delta is the most important option Greek because Delta measures two things. Delta measures your probability of success, and it also measures your directional risk. So when we're talking about directional risk, Delta measures how much you would make or lose based on a 1-point move. So if you bought 100 shares of XYZ company and it went up $1, then that means you would make $100. If it went down $1, that means you would lose $100 because your directional risk based on Delta is on a 1-point move. So if you only had one share and it went down $1, then you would lose $1. If you had 500 shares and it went down $1, then you would lose $500. So when you talking about directional risk is where you lose at. Okay, so your direction, if you buy something and you're bullish and you want it to go up, then your directional risk is down. You fear that it's going down. So Delta measures that. It's a number of ways you can look at Delta as a risk measurement, but primarily it's based on a 1-point move on whatever you're trading, how much you would make or lose based on that 1-point move. So as for probability, Delta measures what's your probability of success based on the position you have on. So if you were buying and selling something at the money, which is this horizontal line again right here, when you're buying and selling something at the money, the probabilities are basically the same. They're 50-50. It's like a coin flip, okay? But when you're selling something or buying something that's out of the money, and we were talking about out of the money before on the call side is this area, and out of the money on the put side is this area. And we're going to be discussing the put side primarily tonight. So this is the out of money area. When you buying and selling something out of the money, the probabilities are significantly different based on what you are doing. So if you're buying, let's say this $29.50 again at the 40 delta, this is the 40 delta here, this is that delta area, this whole line over here on this put side of the right side of this option chain. So if we're looking at this $29.50 and we click on the ask, then this is telling us at that 40 delta that if you buy something, you have a 40% chance of making at least 1 cent at expiration. Okay, and this is all based on expiration. It doesn't mean that you can't make some money when you buy something or sell something before expiration, or you can't take it off. But all the probabilities are based on a 50-day expiration and the volatility that is currently on this 50-day expiration period, which is 17.7 on this right now. And the expected move over here is plus or minus 121 or 122 if you want to round it up. So the probabilities are all based on that 51 days expiration. Okay, it's not based on 25 days or 30 days. It's based on 50 days at expiration. So if you buy in this and you expect to hold this to expiration, then it's a 40% chance that you would make at least 1 cent at expiration if you're buying this. Okay, and if you are selling this, all right, so if we're selling this $29.50, clicking on the bid again, so, and it's red. If we're selling this, then it's a 60% chance of making at least 1 cent at expiration. It's a 60% chance of making at least 1 cent at expiration, and not the 40% like when you're buying. And it's different because it's a subtle difference, but it's different because when you're buying, I'm just going to click here and act like we're buying. When you're buying, you need a big move to happen before you win. It needs to go past this strike, this $29.50 at expiration for you to win. So you need a big move there to happen. When you're selling, I'm just going to change this back to red. When you're selling something, you need a big move to happen before you lose. Okay, you need a big move to happen before you lose, because when you're selling something, and we're going to talk about that tonight, when you're selling something, you receive monies into your account immediately. And when you buy something, monies come out of your account. So when you're the seller, monies come into your account. When you're the buyer, monies go out of your account, right? So it's a subtle difference, but that's why the probabilities are different when you're selling and buying out of the money. When it's at the money, it's pretty much the same. All right, so let's discuss one more thing, and we're going to talk about the put side. So we're going to talk about what happens when you buy a put. So if we bought this, clicking on the ask again, and we bought this $29.50, if you are the buyer, then if you're a buyer of an option, okay, a call or a put, and we're talking about the put here, then you have the right, but not the obligation to sell the underlying, whatever you're trading at that point at $29.50. So in this case, we're once again trading the SPX, the S&P 500 cash settled index. So if we buy this, we have the right, but not the obligation to sell it at $29.50. If you are the seller, then you have the obligation to take ownership of the shares at $29.50. So the best way to be able to explain this, for we can all understand, is that if you buy insurance from a company like Geico or Progressive, and you get in an accident, and the accident is a small accident, and you have the right to have that insurance company take care of that small accident, but you don't have the obligation. You can decide to just pay for it yourself, so your insurance premium won't go up next time you renew your policy. But that's your right. Okay, you do have the right to have them fix it, or you have the right just to do it yourself. But if you are the insurance company, if you were the seller, the insurance company, they have the obligation to make you whole if you decide that you want them to fix your car. Okay, they have the obligation to do that. But the insurance company has the probabilities and on their side. As you know, we don't get in car accidents very often, and if we do, maybe once or twice in our lifetime, that we get in a car accident that's completely totaled, and the insurance company has to pay out completely. But they understand the probabilities. They base it on a number of different factors, like your age, your zip code, the type of car you have, your driving history, all that kind of stuff. And then they decide, okay, I'm going to sell you a car insurance policy. But you know, nothing's 100%, but their probabilities are definitely very high. Okay. So that's how you want to understand the right when you are the buyer, and then the obligation when you are the seller. And it's the same type of concept on the call side, but instead of having to take ownership of shares, if you are the seller on the call side, clicking on the bid, you have to sell the shares at that point if the buyer exercises their right. And the buyer would hardly ever exercise their right, almost 0% of the time that they'll exercise their right if it's not in the money. So this is important to understand the in the money kind of concept that we're talking about. So this is the at the money line, and this is in the money on the call side. And then obviously this is out of the money on the call side. Okay, so the seller would probably almost 100% of the time not exercise their right when it's out of the money, because then they will just be giving you free money at that point. You actually want that to occur. But if this is in the money, and in the money once again is on this side, on the call side, then the buyer has the right to require you to sell them the shares at the strike price. Okay, at the strike price. And it's the same type of concept on the put side if it's in the money. Okay, if it's in the money. All right, so this is in the money on the put side, the ITM, and we're going to be talking about that primarily tonight. And this is out of the money. All right, so that is the basics I wanted to cover tonight, but we do have a YouTube channel. You can go to YouTube, type in the Dorian Way, and you can look at some of the videos we have. The channel is pretty new still, but we do have several videos there, and one is on the basics, and I go over this kind of stuff in a lot more detail. So I encourage you to go and view that. And if you have some questions after you look at the video, you can always email us at support@dorianway.com. All right, so we're going to jump into dissecting the put spread now and jump a little deeper. All right, so what is the put spread and what are its mechanics? The put spread is when you buy or sell a single put at a strike price and simultaneously sell or buy another single put at a lower strike price. For example, you sell a put at the 100 strike price, and at the same time you buy a put at the 90 strike price. This is a 10-point wide put spread. Okay, it's a 10-point wide put spread. So when you're buying or selling a put spread, it is two legs of the spread. So when I say legs, I mean if you only have one put, then that's one leg. If you have two puts, then that's two legs. Okay, and if it's at different strikes, if you have two different puts at two different strikes, then that is called two legs. Okay, so a put spread represents two legs. It's never less than two legs and never more than two legs. A put spread looks similar to this. Let me bring this up here. All right, I'm looking at the Tastyworks platform. So if you're going to buy a put spread, it looks like this. Okay, let's just look at this 2970, 2960. It's a 10-point wide put spread, and this is being the buyer. Okay, when you buy, you are closer to at the money, and once again, this line right here is at the money when you're buying the put spread, and the leg that is that you're selling is further from at the money. And when we clear this, and then if we're selling this now, and so the one that you're selling is closer to at the money, and the one that you're buying is further from at the money. Once again, this is the at the money line here. All right, so when you're looking at a put spread, how it's set up, it looks like this on the curve view of Tastyworks. All right, so you want it to go up where this green area is at. Because you're bullish when you're doing this kind of put spread, and you lose if it goes down past your 2970 strike, but you have a stop loss at the 2960. Okay, this is how it looks. You have a stop loss at the 2960 here. So this is how it looks on the graph, and this is how it's set up. And if we move this a little further, just so you can see this a little better, I went like here, and it's a 10-point wide spread. Again, if you're the seller, if it goes down past your strike, that's when you lose. Okay, when it goes past your short strike there. All right, so let's hit clear on this and let's move on. And all right, so what is a long or bear put spread and why should I use it? The long or bear put spread is a vertical spread strategy that creates a net debit in your account. Okay, net debit means that monies are coming out of your purse, coming out of your wallet, coming out of your account. Okay, the option you buy is always more than the option you sell. The bear put spread is used to short and underline or to hedge against a bullish position. All right, so let's look at the bear put spread here. So this is a bear put spread. You're buying the one that's closer to at the money. So you're clicking on the ask and you're selling the one that's further from at the money. So in this case, this is a 10-point wide spread. And the one, once again, it's going to be repetitive tonight because I want to make sure you understand. This green one is the one that's closer to at the money. So it's going to cost more than this red one that's further from at the money. So this is why this is a net debit out of your account. This is why monies are coming out of your account. And when you do this type of trade, when you buy this put spread, you are bearish. You want it to go down. You want the underlying that you are trading, underlining that you're trading to go down. And when you're looking at an option chain, going down is going in this direction. Okay. It's kind of counterintuitive because on the screen, it looks like we're going up. But these prices are going down in this direction and they're going up in this direction. So when you buy one of these put spreads, you want it to go down. Okay, you're betting that something is going to go down. Or you're hedging. Okay, so let's just say you had 100 shares of XYZ, whatever you had, whatever you like, Starbucks, Amazon, whatever. And when you have 100 shares that are long, you want it to go up. Your directional risk is down. So to offset that directional risk, offset those shares from going down, you can buy a put spread. So if it goes down, the put spread is going to offset some of the losses. Okay. Obviously, if it goes up, you're gonna lose on the put spread, but still win on your position because this is a hedge, and we'll talk about that a little bit more here in a second. So that is the bear put spread. All right. So let's move on here. And let's talk about what is a short or bull put spread and why should I use it. The short or bull put spread is a vertical spread strategy that creates a net credit in your account. So this is monies coming into your wallet, coming into your purse, or coming into your account. So for example, if you had $10,000 in your account and you received a credit for selling a bullish or bull put spread of $500, you now will have $10,500 in your account immediately. That's what you have it in your account immediately, and you never have to give that back. Just like the car insurance company, if you paid them $1,000 for a 6-month policy, and they never have to give that back. If you get in an accident, they can use that $1,000 toward the accident, but that's always theirs. And that's the same kind of concept when we're selling options in the open market, and this is the case when you're selling a put spread. All right, so the option you sell is always more than the option you buy. The put spread is used to make money as the underlying goes up. It can also be used to offset a short position. So the same kind of concept, but the opposite of that bear put spread. All right, so if you're selling a bull put spread, you're clicking on the bid to sell, and we're going to just do a 10-point wide again, and you're clicking on the ask to buy. So the one that you're selling is closest to at the money, and the one that you're buying is further from at the money. And this is a credit into your account because once again, whichever leg is closer to at the money, which is this line here, that's going to be the one that's more expensive. Okay, so you would receive a credit in your account for this. You are bullish. You want the market to go up. Once again, up is going in this direction here, but you are okay as long as it doesn't go past your short strike. So it's the same kind of concept that we were looking at over here on that curve view. We said you want it to go up, right? But it's okay if it goes down some, as long as it doesn't go past this short strike here, right? And this can look a little better if we we did something like this, if we move this over here and we move this over here, right? So this is the at the money line right here. So this is telling you, all right, obviously I'm winning when it goes this way, if it's going up, but I can also win as long as it doesn't go past this short strike. Okay. And then once again, the max loss is here because this is your stop loss there, the one that you buy. All right. So when you're using this, when you're selling something like this and receiving a credit, you can also use it as a hedge, as protection, okay, to offset a short position. So that just say you had some short stock or a short future or some short option call options, and you wanted to offset that short position because the market keeps going up or something such as that. You can sell a put spread because it's bullish and it's going to give you some type of hedge on the upside. Okay, and we're going to talk about that a little bit more here in a second. All right, so that is the bull put spread, and let's jump on and continue here. So what is the best way to use a put spread to go long the market? All right, we just talked about going long the market on the put spread is a bullish strategy. Okay, it's bullish. You want it to go up. So the best way to use a put spread to go long the market is to make sure the probabilities are on your side based on the strike prices you use. We believe that is the 10 or the 5 delta. All right, so let's look into that. All right, so this is at the money again. Once again, this is at the money. And if we go all the way down to the 10 delta, right? So this is the furthest 10 delta on the count here. This 2685. If I click there and then I buy the 2655, so I'm selling this. This is a bullish strategy. Okay, it's a bullish strategy, and I want this to go up, but this is telling me that I have a 90% chance of making at least 1 cent at expiration because it's a 10 delta, and when you're selling it, that means the inverse. It's 90% chance that you make money on this. And as you can tell, it's that way because it's so far from at the money. You receive a credit, you receive that premium into your account immediately because you're acting like the insurance company, and it has to go all the way down. It has to go all the way down past your short strike, past this strike here before you lose. Okay, so if you was the buyer of that 2685, then you would only have a 10% chance because it would have to go all the way down past that before you win. So this is why the probabilities are so great when you are the seller. So if we wanted to just look at this and determine how far is it from at the money based on a percentage, right? So what we can do is that we can take this number, this strike here, that's 2685, and we can subtract it from the last price, which is this 2984. So minus 2984, that equals negative 299. And then you can divide it by this last price again, which is 2984. And that's 10% down right now. So the market would have to go down 10% before it hit this short strike in the next 50 days before you would lose if you did this trade at the 10 delta. All right. And if we looked at this on the curve view again, you'll see how far this is. All right. So this is the at the money line here. And you make money as long as it stays in this area. All right. So those odds are pretty great. And this is what I recommend people do when they're using regular T margin. And we'll talk about the different margining here in a second. But you sell the 10 delta, buy 10 points lower. And if you're new, you get out if your short strike is hit. You just buy back your option if your short strike is hit. All right. So that's the short strike there. So you have a 90% chance of making at least 1 cent at expiration. And when you're looking at these probabilities, this delta probability that I was telling you and was talking about earlier, the probabilities, once again, is based on the 50 days. that to expiration. But if it's a 10 delta, that means that it has a 10% chance of expiring in the money, but it has a 20% chance of being touched. Okay, so being touched is 2 times delta. So if it's a 10 delta, then it means you have a 20% chance of being touched. And so to make that clear, let's go right here and let's go back to the at the money. And so if we were selling this 40 delta here and you were buying this one here, it's saying that you have a 60% chance of making money on at least 1 cent. But this is a 40 delta, so this means it has a 80% chance of being touched. Okay, so if you don't understand the probabilities, you can get scared if the market goes down and this strike is breached. Okay, but there's still a 40% chance that it's going to expire. Excuse me, a 60% chance it's going to expire out of the money. And this is all based on this area here. There's probabilities. Is 7.7%, plus or minus 121. That means it can go up or down, plus or minus 121 based on the volatility right now. Then once again, this 50 days. All right, so let's move on and go back to this PowerPoint really quickly. And what is the best way to use a put spread to short the market? The best way to use a put spread to short the market is to make sure the probabilities are at least 50-50 by buying a spread at the money or a little in the money. Okay, so if you wanted to short the market and you're not doing a call spread, we're not talking about that tonight, but if you experience, you understand you can short the market by selling a call spread. But in this case, we want to short the market by buying a put spread. So if we bought this put spread here at this 40 delta again, then that means we only have a 40% chance of actually making money on this short put at expiration, okay, at this short put spread. But if we move this closer to at the money here, then now we're going to have a 50% chance of making money at least 1 cent at expiration. And then if we move it a little into the money, then we still have basically a little over 50% chance of making money. Okay, so this is why I encourage, if you want to short something and you want to buy a put spread, you do it at the money or a little in the money, so you can have at least a 50-50 probability of making money. Okay, you don't want to try to have a lottery ticket and do this really far out of the money. Like if we were talking about earlier, if you bought this put spread at the 10 delta, well, you only have a 10% chance of making money at expiration on that. That's basically a lottery ticket. All right, so let's hit clear and let's move on. All right, so how do you use a put spread to hedge? The best way to use a put spread to hedge is to use a starting strike price that provides a good hedge for the least amount of capital, and that provides a realistic chance of making money on the hedge if used to protect a bull put spread. All right, so we talked about buying a put spread at the money. All right, so if you buy this put spread at the money, it's going to cost $340 to do that at the money. So that's pretty expensive, right? But you do have a 50-50 chance of making money on your hedge when you do that. Okay, but it's going to be an expensive hedge. If you buy it at, and what I recommend, you buy it at the 30 delta, and this is a 10-point wide here. So instead of $300 and something, it's basically $200, $205 here. So this hedge is a lot less, and you have a 30% chance of making money on this put hedge. So 3 out of 10 times you will make money on this hedge. But when I'm recommending to, let's say you sold something on, let's hit clear here. All right, we can hit clear. If you're selling something and let's say you received $100 on whatever you sold, instead of using the SPX to hedge, you might want to use the SPY because it's a smaller index and it's cheaper to hedge. So we were looking at 50 days there. So let's just go to this 51 here. And if you received $100 on selling something and you wanted to hedge it, you can go to the 30 delta. And this is what I teach in the Dorian Way when we're doing one-on-one mentoring, or if we're doing group style classes. You go to the 30 delta. So it's no 30 delta here. So we're going to do the 31, clicking on the 28, it's 28.9, 289, and selling the 288. So this right here, if I received $100, then this is going to cost me $21 before fees, okay, for commissions and fees. And so when I'm teaching people in the Dorian Way, we hedge everything that we trade. So if we receive $100, we hedge 20 to 30% of that. So we take 20% of that $100 we received and we hedge, just like an insurance company. So some insurance company like Geico or Progressive, once again, they sell a lot of different policies to people, and then they use a reinsurance company to hedge their risks. Okay, so they don't have all the risks on the table. So, and this is the same kind of concept as what I teach in the Dorian Way, is that when you're selling premium, you're being that insurance company and you're getting all that premium in, you take 20 to 30% of that and you hedge it. And you do that by using stuff like the SPY, using futures contracts, using the actual underlying that you actually sold a option in. So this is just another way to think about it. All right, so let's move on. And this is important part. It's one of my favorite parts of trying to figure out the difference between the SPX and the ES. So is it better to sell a put spread in the SPX cash index or the ES futures index? The answer should be based on capital efficiency if all else is equal. All right, so you have the SPX here, and let's jump over here to this right here. We're gonna go back over to the SPX, and we're gonna try to make this as equal as possible. And so let's go to the 50, let's go to this 51 days. Actually, it's 49 days here. And let's buy the 10 delta. All right, excuse me, let's sell the 10 delta. So we're selling the 26.85, buying the 26.75. This is a 10-point wide put spread that you sold. So you are bullish on this. This is a bullish strategy. You see here on this graph here that you're really far from at the money, and you have a 90% chance of making at least 1 cent at expiration. So when you do this, you receive on this 10-point wide spread, you receive $65. Okay, you receive $65. And if we click this review, they have all these different things up here, but we're going to click review anyway. So if you click review, this is saying that you're going to be able to make $61, $61.42, and your buying power is reduced by 938. Okay, so buying power reduced by, that is what is called a good faith payment. Okay, it's when you're trading options, you're not paying interest. Okay, you have to get a margin account, and they use the terminology margin, but you're not actually using margin. You're not paying interest. When you trade options, when you're selling something, you have to put up a good faith payment. And a good faith payment is similar to like when you go to buy a house and you go into this, talk to the seller, you agree on a price, they go outside of their house and they put a sell pending sign in the yard. And then that causes a lot of different people to move, that just drive by their house because they think that they already have a buyer basically. Well, for the seller to be able to do that, you have to give them a good faith payment. And it all depends on the size of the house, but let's say it's $5,000. So you give them a $5,000 good faith payment. And if you back out of the deal, then they get to keep your $5,000. Well, that's the same kind of concept with options. You have to put up a good faith payment. And it's basically saying, all right, so you put this to the side, and if something goes wrong, we have this monies to take care of it. And this is what it is here. So if you have the 61 over the 920, the 38. So you go 60 to figure out how much percentage you're making on the buying part is required, that amount that they put in escrow. You go 61 divided by 938. And so that's 6.5%. So that's a decent return on your capital. It's 6.5%, and you're receiving $61 after fees. That's not too bad. So just FYI, this is saying this order will begin tomorrow because this is after hours on this SPX. But if we wanted to do the equivalent to see what the futures SPX will look like, and let's do that. So when you're looking at the futures, this is the S&P 500 index as we've been looking at most of the night. All right, so you also have that on the futures that is trading right now that you can see over here. This is actually trading live right now. It's moving up and down. And this is what we teach in the Dorian Way. We teach you how to trade futures. It's the same kind of concept as trading regular stocks, but you'll see right now it's a little better with the percentages on the capital. All right, so we're 51 days here because we're trying to be as equal as possible. We don't have a 49-day. So we're going with the 59-day, and we're looking at the 10 delta, okay? The last 10 delta, so we're selling that one, and we're buying 10 points wide like we were doing before. All right, so the strikes are not 10-point wide here, so let's just go right there because that's the last 10 delta anyway, and we will buy this one, which is 10, buy that one. That's a 10-point wide there. And the ES is half the size of the SPX. So instead of doing one contract, you have to do two. So we're doing two contracts, and then we're going over here. So that is 51 days, 10 delta. All right, so this is not a lot of premium, but I just want to give you an example of this. So this is saying you're receiving $36, and the buying power is 301. So you got 36 divided by 301. So it's about 11.9%. So 36 divided by 301 is almost 12%. So on the previous one, you had a return of 6.5. This is basically 12%. So you get a better return, and it's requiring less buying power for the same type of risk. Okay, so the risk is right here. It was basically a max loss before fees is $1,000. Excuse me, before the premium is $1,000. So after premium, its max loss potential is $950, and it's the same type of concept that was on the SPX, but it was requiring $938 for this buying power reduction, and that's because it's different margining systems. On the SPX and on all stocks, it's what is called regular T margin. Regular T margin requires you to put up your max loss on all spreads. So any type of spreads that you do, you have to put up your max loss. On the ES or with futures, it's under span margin, and span margin is based on your portfolio. What is the real risk? What is the probabilities of you actually losing on something? So it takes in the fact that this is 90% from at the money, 90% chance of making at least 1 cent. So it's going to require a lot less buying power to be able to do this type of trade. All right, so that is the difference between the ES and the SPX. And let's open this up for some questions, and because that is the end of the presentation for tonight.